I'm David Cates, President and CEO of Denison Mines. Company's listed on the TSX under the symbol DML and on the NYSE American under DNN. We're a uranium development company focused in the Athabasca Basin region of northern Saskatchewan. Our flagship project is Wheeler River, with a very exciting deposit, Phoenix, being brought forward as the first in-situ recovery uranium mine in Canada.
David, thank you very much for the introduction. Like so many uranium companies, you're in London at the moment. You've got the glamorous background of a London hotel room. How's the week been for you?
Merlin, it's been a good week. These trips are always filled with a variety of interactions for us. We've sort of run the mix of investor meetings and industry meetings, attended many of the sessions, and certainly had casual conversations throughout. So it's been a good week. I think sentiment is very positive, which is great. You're catching me obviously at the end of the week, so maybe a little bit of fatigue setting in, but only from being so busy during the week.
I'll try and ginger you up with the right questions. When you say industry contacts, are you principally referring to peers, other developers, or utilities? You know, what when you talk about industry contacts, what do you mean?
Well, really everybody's here. So many events where we have sort of a common thread around the uranium production, development, exploration space. But also I'm talking about, our intermediaries in the sector, the traders, some of the brokerages, and trying to understand what they're seeing in the market. And then also just many casual contacts with utilities that we've been in touch with, or others, investors that are attending the conference. Really, this year, we've seen all of those groups represented in large numbers. So you haven't had to walk or look very far to bump into someone that you might want to talk to briefly, at least, to understand what's going on in their business and how that might be relevant to your business.
I understand that the mood's been relatively buoyant. For me, one of the kind of the biggest things to come out of it is the new kind of biannual nuclear supply demand projections by the WNA. The new report, they're looking at 3.8% supply growth, and I see in your presentation, which is predates this, you're looking at the uranium demand rising from around 200 million pounds per annum today to above 250 million pounds per annum in 17 years, by 2040. It'll probably, once the new numbers are in, it'll probably be even higher than that. But that's still, considerable growth there, 25% growth over 17 years. You also include in your presentation that kind of the covered demand 100% now going to much less covered demand in the future. I eyeballed it at around 15% is kind of covered for 2040. What do you see? And obviously you'd like to see the Denison in that supply mix. But can you just kind of give some general comments about your take on the supply across the sector in the coming years?
Well, look, I mean, what's very interesting is in our materials, we're using some of the numbers that are published by UXC, which is one of the industry price reporters, and of course we have price reporting also from Trade Tech, and the WNA prepares this report on supply demand basically, and they're all prepared differently with sort of different mandates and different objectives. But what's telling, I think, Merlin, right now is that there's quite a consensus that demand is projected in all of these different sources in a variety of cases to be vectoring from positive to very positive. There's no disagreement about demand. And on the supply side and on the contracting side, there's also a common thread of recognizing that utility needs are not covered they're covered in the immediate future, which is a good thing because the lights need to stay on, but they're not covered when we start looking out not too far from now. And where they're not covered, we also have alignment of seeing that there is a shortage or a a question mark over where the supplies will come from to have the utilities become covered. And so all of these reports are confirming one element or another or the same element, that utilities certainly need to continue their procurement process to cover themselves for existing demand and any growth that's projected, but also that there is great uncertainty around where those additional supplies will come from. And the WNA does a useful analysis, but not one that factors in price. And so they really are looking at projects from a supply side in bulk, if I can say that, and not dynamically. And it's fine. I mean, that's the purpose of that study. It would be, I think, more informative if they tried to lever on price, but I think it introduces a lot of judgment that they're perhaps not willing to get into. But when you look at it on bulk, they are seeing that there's an enormous amount of what they call unspecified sources of supply. And even where they have specified the sources, where they can say, well, we understand where this might come from, many of those sources are not currently producing, or may have significant question marks. And the nature of these kind of working groups and an organization like the WNA, of course, they're doing their very best to provide meaningful information, but a study like this will have a cutoff date. And so when you look at specified sources of supply, some of those may include places that today, even based on more recent developments, for example, a coup in Niger, could mean that specified source is at risk. And, you really have this confluence of things on the supply side of utilities not being covered. They need supply, but then the studies showing, well, we're not exactly sure where the supply will come from. And then if you sort of dig the one layer deeper and say, well, what does it take for the supply to materialize? Of course, that takes you to the question of price and timing.
Right. Yep.
And that is a challenge, because then you start to go back to some of those other reports where people have done cost curve type projections to show at what level is an estimated cost of different projects and how many projects are needed and what will be that marginal project that balances the market. And those certainly start taking you to a different place. And where I would layer on even one complication that isn't in these studies is that many people have not updated costs. And while we've recently put out an updated technical report that reflects current costing for Phoenix and Griffin, we are an outlier. And the nature of our industry being so non-public at times means that we do not have a wealth of information about current cost estimates. So when you go to that cost curve,
yes,
what the numbers you're looking at from a chart that someone prepared 2 years ago from data that was 3 years old then, there really ought to be quite an error bar layered on top of what we predict the incentive price will be for projects. And sorry to overwhelm with this, Merlin, but then layer on how much money do people need to make these days for projects? Because the risk-free rate is not zero anymore. So the internal rate of return necessary for a project to be economic today is much higher than it was 3 years ago. Factor that into the incentive price, and it's going to be much higher than people expect.
So let's just focus on that point. So what you've just said is that the incentive price, quite often if you go to presentations, you hear that they'd be using 60, 65, sometimes 70, sometimes as high as 80 as the required price to stimulate a final investment decision in project A or B or X or Y. But with the costs having risen because the studies are out of date, what you're effectively saying is that the real incentive price is going to have to be higher than that to trigger that final investment decision.
100%. And because we've not seen very many updated studies, we're left to guess what that price will be. And even the companies that have those assets, they have to do the work to make proper business decisions, to understand what price is sufficient today versus the price they might have expected to be sufficient 3 years ago. And I sort of then layer on the internal rate of return as well, because cost is one part, but to be incented, you have to make an adequate profit. And the adequate profit today is a higher number than it was when interest rates were zero, right? When you have a risk-free rate,
Yes,
when you have a risk-free rate, 5 to 6%, to justify investment into a risky mining project, you can no longer get a 12% IRR. You're going to need to see a 22%, a 27% IRR. That drives up the price you need to be incented even further.
Okay, thank you. That's really clear. Let's now just focus on Denison, because you talk about the next thing for Phoenix being a final investment decision, and you said you put out a study recently this year, so they're fresh numbers. What incentive price do you see as being required for? Perhaps I want kind of a life of mine average to make this work. And what are your next steps between you and between today and an FID?
Well, look, I mean, Merlin, the first part there on incentive price, I think fortunately and uniquely for Denison, we were incented to advance the project when the uranium price was $30. And that's owing to the uniquely low cost profile of Phoenix as an in-situ recovery mine. And so we've already been investing and advancing, because the market, even in 2018, in such a depressed state, was going to generate an enormous return for our shareholders just through the realization of what I call the developer to producer re-rate. And so, it's a bit of a cheeky answer to say that we're already incented, and we already were, and we don't need a higher price. That is not the norm for the industry. I would say we're an outlier, and there's a literal handful of assets that can make that claim. But we need far more assets to meet the demand requirements. And so that's where we've been so aggressively moving the project forward. And then maybe to that second part of the question, what remains? So we've completed the feasibility study, and just for background for everyone, of course, this is a technical study completed in accordance with our Canadian security standards. We call it the NI, National Instrument 43101. This is a very rigorous technical reporting standard. The technical report was prepared by a third-party qualified person. We used international engineering firm Wood. They have, global expertise and are the authors, the lead authors of the study. And so it's not Denison wishful thinking of what the project's outcome might be. These outcomes have all the costs, the assumptions, technical assumptions have all been validated and signed off by third-party qualified individuals. With that in hand, we're confidently moving forward into what we call front-end engineering design and detailed design. And that front-end engineering design is sort of the final stages of design optimization, as well as identification of long lead procurement items, which will then transition into detailed design, which is, as it sounds, detailed engineering design, getting right down to the levels of drawings that would be used for construction. In parallel to that, we're advancing permitting. And really you need the convergence of engineering design and approval to execute your project, to be able to make that final investment decision, as well as access to financing. So permitting is a rigorous process in the Athabasca Basin and in Canada for a uranium mine. We're grateful to be several years into the permitting process, because time is the kind of thing that you can't buy for a new discovery. And now pleased to report that we're in the final stages of that permitting process with a draft environmental impact statement. This is a 6,000 or 7,000 page document submitted in October of 2022, so almost a year ago, which puts us well into the review and process, public and regulatory review process, with our view being that this was always a 2 to 3 year process. So that puts us, call it 2 years, give or take, in our expectation from being permitted, which would then put us into about a 2-year construction timeline once we make a final investment decision. And then just to round out that whole timeline would see us in production in the 2027 to 2028 period.
Okay. The NPV on your project, post-tax, is around $1.6 billion. Is 1.48 attributable. Your market capitalization's 1.6. The difference could be the cash and investments. So you're effectively trading at 1 times the NPV of your project, which is a great result for a development company. I mean, if you look across the gold and the copper space.
Well, I mean, Merlin, it's. I mean, that would be if we were only valued on Phoenix, right? And of course, we have a portfolio of other assets. So we trade on a consensus NAV basis, probably in the 0.6 to 0.7 type range, pretty much in line with developers in other commodities.
Yeah, with a 2-year kind of permitting timeline, how do you manage the kind of the market expectation? Because there's the market runs on a short-term basis. Portfolio managers kind of do mark to market on a daily, weekly, monthly, quarterly basis, and you've got these long-term kind of development timelines. How do you communicate that discrepancy? How do you manage that process?
Well, I mean, do you mean from a news flow and a investor interest standpoint, or?
Yes. Yeah.
Yeah, I think we're grateful to have a portfolio of projects for this time. Absolutely, we've come through a catalyst-rich period for Phoenix with our de-risking activities over the last 4 to 5 years. We've delivered excellent results, and they've all culminated now in the feasibility study for Phoenix. The permitting is perhaps not glamorous, but does have important milestones ahead, as well as advancing some of our work to further our agreements with Indigenous groups. And so those would be the project milestones that will come pre-FID. But what we've done is you'll see, based on our budgets and our business plans, the work we've done at Phoenix has really de-risked ISR mining in the Athabasca Basin in our mind. And so you'll see that we are also active on other assets, and we're aggressive with exploration because we believe we have an enormous competitive advantage with the work that we've done on ISR mining in the basin. And we are working this year on 2 different projects to advance the understanding of ISR mining there. And one would be at our Waterbury Lake project, where we have a field program to collect additional information for our THT deposit as an ISR, potential ISR mine. And we're also working with our partner, Orano. And of course, Orano is a global leader in the nuclear fuel cycle, French state-backed. And the joint venture we have with them at Midwest, we're a minority partner. We own 25%, and Orano owns the balance. And the joint venture has retained Denison to advance the evaluation of ISR mining at Midwest. So these are both very exciting prospects for us to take our industry-leading knowledge and apply it to other deposits, and really show that Phoenix is not a one. Denison is not a one-project company when it comes to ISR mining with just Phoenix. Phoenix will no doubt be the front of this and generate enormous cash flows for us, but we are looking to apply our competitive advantage to other places. And then our exploration activity is really designed to bolster our leadership by finding additional resources that could be ISR amenable, and that's our exploration team's mandate. Of course, if they come upon a large high-grade basement-hosted deposit that's accessible via conventional underground mining methods, we will be excited to make that discovery. But our focus is on finding sandstone-hosted ISR amenable deposits, and we have some excellent prospects that we've been advancing quietly while we've focused on the Phoenix de-risking that I'm starting to become quite encouraged could translate into new discoveries that could quite honestly change the value of the company significantly.
And does that mean that something like Griffin, which is a conventional deposit in your portfolio, you continue to work, but it could potentially become non-core at some stage, or is it kind of, it's core at the moment, but let's see how it goes?
Yeah, look, I think Griffin is a perfect pairing with Phoenix in that Phoenix has such a low initial capital cost. It's really attractive when you think about the value you can create for shareholders. We have such little capital to raise by comparison for Phoenix. And what Phoenix does is generates enormous cash flow, which then can be redeployed into Griffin, which does have a higher capex price tag because it requires shaft sinking and underground mining. Those kind of assets are challenges for development companies because of the capital costs associated with it and the burden on shareholders to fund it. What we've got with Phoenix is an asset that really solves that problem for Griffin, because Phoenix is such high margin and pays back so quickly. I mean, we're talking after-tax payback in like, I think it's 10 or 11 months. And so what do you do with all the cash flow that comes after that? I mean, I suppose you could pay a dividend, or you could redeploy it into another excellent project without having to dilute your shareholders through equity capital raise to fund an underground mine. And so it is. Well, I understand the question, because we love the ISR mining. It is our competitive advantage. But the biggest issue one would have is you have an highly profitable asset and nothing to redeploy the profits into. And Griffin is really an excellent place for us to redeploy the profits, and it gives us a very long life. And it truly gives us exposure now to what I'll call the first leg of the price recovery and this increased uranium demand with Phoenix, and then a funded underground mine to be exposed to the further leg that we might see from a recovering uranium market when we start to see those larger, even higher growth projections for demand, and we start to look at the supply and see what they call the unspecified supply period. Well, Griffin is really well suited to support that period. It would be funded through that cash flow at Phoenix, so that they really are well paired.
Yeah, good. And I've seen so many times the supply side for various commodities underwhelming just when you really need it to come through, and what it does lead to tightness in the market and stress, which gets reflected in price volatility. But that's a topic for another day. David, thank you very much for your time. I appreciate it's been a long week for you in London. Good luck with your remaining meetings. And if you were to kind of summarize the news flow over the next 6 months, is it kind of exploration, ISR? Is it more kind of the broader portfolio than necessarily the kind of the permitting news flow out of Phoenix?
I think you're going to see a peppering back and forth between periodic updates on how things are advancing with Phoenix, including permitting, but sort of spiced up, if I can say, with the other assets and the work that we've been doing quietly in the background as we move towards really a project execution focus on Phoenix, and now starting to look at the project evaluation efforts and exploration on the other assets. So I do think we have quite a dynamic mix of news at a time when the market, frankly, needs companies to be aggressively moving projects forward. We're answering that call, and I'm proud of the plan that we've developed.
Go out there, be aggressive. Good luck.
Okay, thanks, Marlon.